Anyway, here we go again. So, thank you very much for attending today's session. Um, this is, I call it advisor installment warrants, but essentially it's just a related party LRBA over shares and unit trusts. It's quite a sophisticated strategy, and I outlined that certainly in the our first little session we've got here. From us, I know I've got a lot of individual trustees on, so they're the guys from the ATAA, so welcome there. This is not going to get a huge, in-depth, detailed strategy where I'm going to go through a lot of legislation, but I have to go through enough stuff in order to make sure that this works appropriately. Really, at the end of the day, our professional life is measured, particularly for those of you who are accountants or financial planners, or SMSF advisors. Really, at the end of the day, it's measured by the mastery we have over strategy. I've seen a number of people out there that offer just simply documents and etc. But at the end of the day, a document's a document. If you don't know what to do with it, it really is quite irrelevant. Particularly as we're going to go through, I'll show you how to create one yourself, which actually has 6 documents in one. To actually try and achieve that or build it, honestly, would take, you're looking at thousands and thousands of dollars if you went to a lawyer. If you try to do it yourself on an online document portal, you're probably going to be easily, because they're quite expensive holding trusts. They're not like LightYear Docs where it's only $99 a document. They're quite expensive. You'd probably be looking at $450 for a holding trust or a related party loan agreement. You're probably looking at another maybe $400. And then you've got to have a mortgage deed as well, which is required under the Commissioner's Guideline, PCG 2016/5. So, you're up around about $1,000, $1,200. I said if you went to a lawyer, you'd be looking at $3,000, $4,000, $5,000. It would take you a long time. So the beauty about the LightYear Docs platform and really where we stand out from everyone else is it's not a document platform. It's a strategy automation platform, which I'll show you a little bit later on. Although I have to confess, my typing is a little bit woeful. But we're going to go through. We're going to look at some a case study, the strategy itself, the benefits of the strategy, some of the traps and also the pitfalls. And more importantly, I'll get this recording out to you later on today, and you'll be essentially off running if you're looking at doing it, because now is the prime time to build these particular LRBAs or related party warrants. And so we'll go through why it has to be done. Mastery, when you have a look at this, particularly putting in place, as I said up there, if you're looking at transitional retirement income stream and industry super fund, there's probably about a 1 or 2 out of 10 in terms of mastery. I mean, it has a good impact, but look, at the end of the day, one is, there's really not a, has its basic tax impact, but at the end of the day, it really is not a huge mastery. There's not that much to learn. If you do it in an SMSF, then key with the TRIS is, because it comes out of your accumulation account, you want to set it up, take your 10%, and then what we call fold it back. And I've done a number of sessions on that, which you can find in our resources or our support centre on the LightYear Docs website. Using a holding trust with a related party loan is effectively an installment warrant, but we don't want to call it an installment warrant, mainly because if we do, then potentially, there's different licensing requirements, so on and so forth. So we still call it a LRBA, but essentially the way it's set up, essentially with a holding trust and also a loan, is the same as, for example, a BT or Macquarie installment warrant, which I had a big hand in developing way back in the 2000s. So when we put this all together, it brings in our juicy skill and mastery level up around about a 9 out of 10. Now, the key issues we need to run with the strategy is that we have to understand Section 67A of the SIS Act, and more importantly, that deals with borrowing in relation to acquiring a single acquirable asset. Now, for that, if we have a share, for example, the case study I'm looking at a little bit later is Westpac shares. So I'm just closing the door there. Is Westpac shares essentially a single acquirable asset? If it was a Westpac share, then I'm going to have to do this whole process for each share. Embedded within Section 67A is a collection of assets. So if we acquire the assets or the super fund acquires the assets on the same day, then that package there itself is classified as a collection, and that collection is a single acquirable asset, if that makes sense. So, for example, if I've got 10,000 Westpac shares and I bundle them up into one instalment warrant, I transfer that into an SMSF, and I'll show you that a little bit later on how we're going to do that. Then essentially once we put that in there, then if we want to sell down our Westpac shares, let's say we want to sell 1,000 of them, we actually have to unwind the whole process and sell the whole 10,000, which obviously creates a bit of concern because we need to then go back and repay the loan, etc. So I'd have to transfer some of the shares out in order to repay the loan. So I'm right back at square one. So here's the first track, is that a collection of shares. If you sell one, you've got to sell the lot. So when you're dealing with a big parcel of shares, you may want to do not just one. You might want to cut the 10,000 into 3 lots, one 4,000, another 4,000, another 2,000, to give yourself a bit of flexibility, if that sort of makes sense. And so then you can choose that if you want to get rid of some, you'll get rid of the 2,000 or the 4,000 or the 4,000. So you might end up with 3 packages of LRBAs or instalment warrants. So I'm going to switch into gear now. So when I start talking, I'll talk about instalment warrants because it's easier to talk about than LRBA with related party loan over shares or units. The key one here is the PCG 2016/5, which provides us with the Commissioner's Guide on LRBAs. So let's just jump out of that and have a quick scan. I've got here, we'll be making this a little bit later on, which is our related party LRB establishment pack in accordance with this. You can see here when we come around to doing the strategy, there's 6 documents in that strategy itself. And the idea about the way it's set up the strategy is it's all put in a specific order for security, compliance, and also safety, which is absolutely crucial. One of these out of line and the whole strategy falls apart. So the 6 areas that you're going to see when we get to the document index is the Commissioner's Guideline, which I'll talk about in a second, the limited recourse borrowing arrangement, so that's the minutes of the trustee of the fund. The fund actually has to work that out. Limited recourse borrowing arrangement, so setting up the trust, the minutes of the trustee of the holding trust or bare trust, the related party loan agreement, and the mortgage deed. Now, of course, we could add a couple in there, and we will be releasing this early next week. I will be showing you the back end of our system, which obviously it's a lot prettier on our website. But we will be releasing it next week, which will also include an investment strategy in there if you choose to use the investment strategy if it needs updating. But if it doesn't need updating, then we don't go through that process. So the first part of that strategy automation is the Commissioner's Guideline. And you can see here, it's released PCG 2016/5, which deals with arm's length terms for limited recourse borrowing arrangements. So these are what we call the safe harbour rules. So one, when a self-managed super fund, let me just get my little annotator so we can follow what we call the bouncing ball. So when a self-managed super fund acquires an asset under a limited recourse borrowing arrangement, the non-arm's length incomes provisions in section 295-550 of the Income Tax Assessment Act may apply to ordinary statutory income generating from the asset if in terms of the LRBA not consistent with an arm's length dealing, which means effectively any dividends or capital gains that accrue from that transaction, essentially, so for example, if we did a 0 interest related party loan, any income or capital gains from that transaction would be taxed at a rate of 45%, which means that we're in a bit of strife. This guideline sets out the safe harbour terms on which the SMSF trustees may structure their LRBAs consistent with an arm's length dealing. So I won't go through that because we've got a lot to go through, but in essence, the safe harbour, if we meet all the terms and conditions, then we are A-OK as far as the Commission is concerned. And if it's subsequently looked at in an audit, then it's fine. Now, mind you, we can still go out to the marketplace and find another commercial lender. But look, if you're doing something like this, it's best just to stick within the tram tracks or the railway tracks the Commission has provided. Now, the first one is the assets required is real property. I've done another session on real property we've got already up on our websites. a related party loan with real property that meets all of these conditions. The ones we want to look at, and again, it's hardly ever, well, virtually never been used in Australia. Let's have a look through this. Safe Harbour 2, which is where we are, so applies when an SMSF uses an LRBA to acquire a collection of shares in a stock exchange listed company or to acquire units in a stock exchange listed unit trust, so Westpac Property Trust. Safe Harbour 2 also applies when SMSF uses an LRBA to refinance a borrowing used to acquire such a collection. So later on down the track, it can always refinance. The ATO accepts that an LRBA used to acquire to refinance a borrowing used to acquire stock exchange listed shares or units in a unit trust is consistent with an arm's length dealing. The terms of the borrowing are established or maintained throughout the LRBA. So if we have a look down there, we have a look at our indicator rates. It's in fact not, we'll have a little bit later on, but they're actually a lot higher, those rates. And what we've got from there is it's up around about 7.93. We can choose variable or fixed. The term of the loan is 7 years, and we need to have a mortgage deed. So that's all encapsulated within these set of guidelines. So let's just jump back for the sake of brevity and go back to our, our key issues. So we now know with PCG 2016/5 that essentially with that one, we can have a 50% guideline, which is great. I'm sorry, my little computer's frozen. But anyway, we'll go down that track. So apologies for that. I'll just see if I can get out of this. Again, it's a new little system. So let me go through and I'll just get a PowerPoint. Sorry about that, I'll have to edit it out from there. And I'll just go back in. Again, many apologies for this one. So LightYear presentations. If we go in, then we should have there the advised warrants. There we go. Again, apologies for that one. As I said, it's just a new computer. There's a bit of a word of warning there for all of you. I had a client who posted apparently a good press release on LinkedIn, and of course, Dumbledore's. What I did is I ended up going through a process of clicking it open, and then I ended up getting a virus, which I've only just got. Well, the way I got rid of the virus is I spent 20 hours on it and ended up having to get a brand new computer. So don't click on any links you do not know what's in there. So with the 50% rule, essentially what we've got there is the LVR is effectively 50% at the time of the acquisition. There's a Q&A, there's quite a few Q&As around LRBAs by the ATO and related party loans, basically saying that if the share price drops post that, does that impact the LVR? And effectively, what the Commission says is that there is no impact on that. The LVR is tested at the time that the shares are actually being transferred in under subject to an LRBA, if that makes sense. So if it tanks. Now, with that one, what happens if, for example, because the lender is a related party, which could be an individual, a family trust, a bucket company, etc. If we have a look at that, if it really tanks, drops by, say, 70 or 80%, which would be Armageddon for most of us, but if it does, what can happen? One of the things there that I've always argued is that if it goes down quite considerably, and there's a loan on it, effectively the trustee of the SMSF can walk away from that loan and effectively just hand back the shares to the lender, because the only security that the lender has is over the shares. They can't access assets inside that superannuation fund. So their only recourse is against that parcel of shares, which I'll talk about when we get to the case study. So effectively, from our perspective, is when we go through and have a look at it, if it tanks by a certain amount, at any point in time, we can always hand back those shares to ourselves, which is not a bad idea, because what will happen is that'll give a capital loss to the SMSF because they've acquired the shares at X. They've got a capital loss, and it means also that our individual or whoever is the lender receives a share back at a lower cost base, assuming, of course, there's a loss. So we've actually booked a loss inside the SMSF, which generally we don't want to do. It's preferable to do it outside. But the benefit of obviously putting these into SMSF is to book a gain in a tax-free part of the fund. So what we don't want to do is mixing contributions and loans. That's basically where the real mystery lies. So let's go through it's a case study, and I'll take us through step by step. Again, there's so many different variations of this. What I've assumed is I've got a client, John Smith, who's got 10,000 Westpac shares valued at $240,000, which is around about the current pricing of Westpac. Sorry, the last hour I've been smashing out these figures. So someone like Ian or Rob Port or those others, particularly ATA guys, you'll have to bear with me, but with these figures, pretty sure I got it spot on. So the expected dividend is payable in December, which was the case last year from Westpac, is fully franked at 94 cents a share. So that's what they're expecting. So once we gross it up, there's essentially a 40-cent franking credit in there. So we gross that income up to $1.34, and that would ordinarily be outside. And they've got a franking credit or $4,000 in total. So if this is the only income that he's living on, plus obviously his superannuation income, he's not paying any tax anyway. So it's not a bad strategy. So this strategy is about really getting rid of capital gains tax for us. If we go to a lot higher situations, so we've got a larger parcel of shares, say $500,000 with quite a bit of income, or our client has not just living off dividend income but has rental income, etc. outside, then effectively it becomes even more powerful. But we'll go through those figures. So again, Westpac shares 10,240, 94 cents per share, grossed up to $1.34. So he's going to get $13,400 assessable income. But essentially, we're going to get $9,400 in cash, and there's a franking credit $4,000. Now, John's accrued capital gains on the holdings are 120. So, in fact, he's done quite well on these shares. So, once we take into account the 50% discount, that's $60,000, which would be added to our assessable income, or to John's assessable income. Now, with that one, that would only apply if those shares are disposed of. So there's a accrued capital gain, or there's a latent capital gains tax liability in there. Now, what we can do with that one is, if we transfer it into our super fund, although we could have John Smith and then John Smith through his company being the only director into his self-managed super fund, and virtually it's still John Smith's whole family issue, but because they're different taxpayers, there will be a realisation of a capital gain if we transfer those shares in. And so that means there's a $60,000 which will have to be added back to his assessable income. He's 65, so it means that he can access any money he puts into super. In fact, really anyone over 60, if you've got a good advisor, you should be able to access all your superannuation anyway. He's got $1 million in an account-based pension with an 80% taxable component. So with that one, obviously any income being generated on the pension side, or any assets inside the fund, is completely tax-free. Likewise, any pension income that he takes is also tax-free. With $1 million in there, he can choose exactly the amount of income that he wants from that pension. Mind you, at age 65, is at a 5% minimum income he must take out of that pension, which is $50,000. Anything in excess of that, probably not so much for him. It depends on whether he's going to be retired or not, but generally use a commutation rather than income. But that's getting a little bit more sophisticated. So we've advised John to transfer the shares into the fund. For the current year, because he can't use the bring forward rule, the 3-year bring forward, because he's already used that, his non-concessional contribution component is $100,000. Now, mind you, in order to transfer the shares and make a contribution, we do have to show that John has effectively worked for 40 hours over a 30-day period at any time during the year. So whether he goes out and does a bit of walking and, does the old shuffling of the mail order stuff around, the Salmat stuff that we get in our letterboxes, does that for a month. Alternatively, there's certainly an argument that if he has been living on his shares and managing his portfolio, as I know most of the ATAA guys do spend, inordinate amounts of time in their computer, they're effectively self-employed. So as long as they can logbook that 40 hours, then they're essentially up and running. So the key criteria there for the SIS regulations, which is 7.04, we have to show that he has been working. If he was under 65, there's no work requirement. Between 65 and 75, it's 40 hours over a 30-day period. John's only got tax-free pension income and dividends to live on, so let's go through what to advise. Is there any questions so far? Just let me know, put it in the Q&A or up on the chat and I'll answer. So what I do is I start working backwards and I have a look at Commissioner's ruling, and we remember that we can take 50% as a related party loan, because the value of the shares going in, if I just go back, is actually $240,000. Now, if I contributed all those, and it's an in specie contribution, which means we simply do a transfer from John into the Smith superannuation fund. If I did that, that effectively would be a $240,000 contribution. Now, if I did that normally and it was all non-concessional, then what happens from there is I'm only allowed $100,000. Can everyone see that? So I'd have $140,000, which would be excess non-concessional, which the Commissioner would come back. If I did that now, the Commissioner would come back, because I'm doing an income year ending 30 June 2020, he'd probably come back to me around about May or June 2021 and say, look, you've got $140,000 of excess non-concessional. You've got two choices. You either pay tax at 45% on that, or you have to withdraw $140,000 of that non-concessional, which isn't too bad. I mean, he's on a pension, but there's a different way of skinning the cat, which we're going to look at the moment. So that's a worst case scenario. So let's work backwards, and that's where the LRBA fits the hole, because essentially we can, if we use Commissioner's ruling PCG 2016/5, then 50% of it can be our LRBA, our instalment warrant. So our instalment warrant is a 50% gearing. So it means that we're going to be lending. So John is going to be lending to the superannuation fund $120,000, which is 50%. And of course, we're going to look at, when we get down to looking at the documentation, the term on that is 7 years. And we use a variable, and then we're going to have a look at the interest rate, which is I think about 7.93. Now, when we get rid of the CGT, so that's the next stage, is I've transferred that in. We don't want to do this if John's actually got to pay CGT on the $60,000. So what I do there is effectively on the $60,000 that's going in, which is the capital gains tax. Remember, we had $120,000 capital gain, 50% reduction, so $60,000 would be included in my assessable income. So what we do there is we're going to claim a tax deduction of $60,000. So we're putting in $120,000. So $240,000 of shares are being transferred in. $120,000 is going by way of loan. The remaining $120,000 is what we call an in specie contribution. Now, what John's going to do is that contribution, he's going to claim a tax deduction for it. Under the tax laws at the moment, because John is just simply a personal contributor to the fund, he can claim a tax deduction for any contribution he makes. If he wanted to, remember, sorry, if I just go back, if he wanted to, we could actually put a contribution of $120,000 in there. But if he's only trying to shelter $60,000, then it doesn't make any sense. So what we do there is effectively we've got the $60,000. is the concessional contribution that he's making. And effectively, what it means is $25,000 is under his threshold for the year. So therefore, $35,000 is above his threshold. So I'm going to go through that one. So the $35,000 also becomes part of his non-concessional cap for the year. So that's the first $35,000. He's over 65, so the remainder of his NCC cap is $65,000. But he has an NCC of 120,000 minus the 25,000. So he's still well and truly under his. So he's not still. He's still under his cap, if that makes sense. So we put $120,000, but $25,000 of that is concessional contribution. The remaining is treated as non-concessional. So now tax-wise, is everyone with me so far? Just ask a question if I've gone too fast, or if you want me to relay this again. It'll be recorded, so you'll be able to go through the numbers yourself. Now, tax-wise, the $60,000 concessional contribution is subject to tax, a 15% tax inside the fund. So a 15% tax on that $60,000 is claiming a deduction. Again, if I can go back, there's no cap in Australian tax law of just straight $25,000 a maximum to make a contribution into super. What it does is effectively that $25,000 means there's no impact on John's personal situation, but it would mean the additional $35,000, as we see, will be added back to his assessable income. Now, mind you, that's going to be a zero because the only other income he had was from dividends, which we've now shifted into the superannuation fund. And the franking credits that we had in there effectively will go to reduce that $9,000 payable. So it'll still be up for $5,000, but we could reduce that $60,000 by deductible interest. So remember, John is lending effectively the shares to the superannuation fund, and that's $120,000. So when we have a look at that, the income, so the interest rate under PCG 2016/5 is 7.94% currently. So when we set up, the document will come up with that, which is $9,528. So John could actually prepay that interest. What will mean is that that income is going to end up in John's hand. Mind you, the dividend's gone, but he'll end up with that $9,528 plus the $35,000 of excess concessional. But what it means is our $60,000 of taxable income inside the fund, which is the concessional contribution, we take out $9,528. So that's around about $51,000. Tax at that is probably going to be around about $8,000 or $7,900, and we've got franking credits of $4,000. So we're still got to pay around about $3,000 or $4,000. Now, obviously, when we put in larger parcels, it actually works out a lot better. The other one then, so when we come around to his personal tax position, so if we add back his excess concessional contributions as assessable income, remember that's what we said. So effectively what will happen is we transfer the shares in now before the dividend. So it really has no income because we've got rid of all the capital gains by claiming a tax deduction. So what we will do though is the super fund, so the Smith Super Fund, will remember for the year ended 30 June 2020, will lodge its return in March 2021, and in that return it will say there's excess concessional of $35,000. At that point in time, John will lodge his return showing $9,528 being what? Does anyone know? That's the interest income which we paid from the super fund to John for that underlying loan. So with that, we then add back that $35,000. So his total income is $44,528. So we lodge the tax return. So remember before what will happen is This will be an amended assessment, or effectively, if we did, well, because what has to happen is John has to lodge his return, but if he's only got 95280, he isn't earning any assessable income. So what will happen is Commission will add this 35 on top. Now, tax payable on 45,528 is 6,020, and that's under the new rate scale. Now, what will happen though is, this is important, the $35,000 of excess concessional, it's assumed there by the tax laws that a 15% tax has been payable on it. But remember, when we looked at this, because of the franking credits and the deduction on the interest, our actual payment there is going to be, what did we say, it was around about, probably around about $4,000. So $4,000 on $60,000 of concessional contribution, that tax relief. We've got, potentially a lot, only around about a 10%, not even that, around about a 7 or 8% tax rate, but we're getting a 15% tax offset. So 35,000 times 15, which is our excess, the way it works is 5,250. He could get a low income superannuation tax offset if we could keep it under 37. So if we didn't have that, if we minimised that interest payment potentially, but if we got rid of that, but we've also got a low income middle tax offset of $700 plus a low income tax offset of $300. So that's $1,000 anyway. So we don't need to worry about that, because those two, 700 plus 300, which is 1,000, added to 5,250, essentially means that we will not be paying any tax, because our tax liability is 6,020, but we end up with $6,200 or thereabouts of offsets. Unfortunately, they can't be refunded or carried forward, but essentially we're in a good position if we have a look at that. You can, depending on the particular client, you can actually end up with, I found out before, that you can end up with quite sizable amounts going in and not having to pay any tax because of that 15% tax offset. So that's what his tax position is. The shares are now sitting in the fund. We've got $240,000 of shares. Ideally, we could put them into a pension. We haven't breached his $1.6 million T-bar, so we could either roll back the existing pension and add this amount. So instead of having $1 million, he ends up with $1.24 million inside the pension. So now means any growth on those underlying Westpac shares effectively will be tax-free, capital gains tax, because he's inside the tax-free exempt pension. And likewise, any franking credits that he receives, the $4,000, will be now refundable. And of course, then he just takes it tax-free from the fund. So it's a nice little play. Again, you might need to go through it a couple of times. I might write a little paper on if I get enough requests from you. But we can start to build 2 or 3 of these. And really, as you can see, for anyone who might have $300,000 to $500,000 of stock, they can actually be transferred in, and we can use those concessional contributions to wipe out the capital gains tax payable and set it up in a perfect situation. We have to watch out how much non-concessional contributions we have. But look, if you've got any particular client issues, please, or individual issues, please just come to me, Grant at ilovesmsf.com, and happy to work through, because I've got a pretty good gut feel on where we are at that. Now, another one there that I just want to raise is, remember, we've got, going back to the case study, we've got 10,000 Westpac shares. Going back to what I said before, we might want to run 3 warrants of 4,000, 4,000 and 2,000, so that if we do want to sell any, that we can choose which one we want, or we could do like 4 and 2 lots of 3, or 5 and 5, whatever. So we're essentially there. So what I'm going to do now is, just before I go on, I'll come back to the, I'll just cover this quickly. I talked about the strategy automation. Generally, we've got 3 systems, depending on where you are. It's $99 per doc. Now, this is 6 docs together. I've potentially put a cost on about $450. I'll probably drop that down to $350 for the package we've got there, just to make it a lot more effective in terms of being able to do multiple instalment warrants when we've got shares. So I'll have a look at that. But as I said before, if you try to do this just one, you'll probably be up to about $1,200, $1,300. It's going to take you weeks to do. If you went to a lawyer, it's going to be $3,000 or $4,000. So generally, we're $99 a doc, except for a strategy automation where we've got multi-documents. If you are an accountant or financial planner, then we have a flat fee of $5.95 a month, and that's for unlimited docs. So it's very easy to create 2, 3, 4, 5, or 6 of these warrants fairly quickly for the client, and really that's just embedded in the upfront cost. Really, for those of you who are advisors, I'd strongly recommend that you do the $7.95, which is unlimited documents plus, of course, you get CPD for us. And, you know, from what we've done here, I mean, this is pretty hardcore CPD if you ask me. So we should be entitled to an hour for that. So please, Ian, maybe take that up with Ashley on that one. So that $200 extra is for firm-wide CPD. If you've got 2, 3, 4, 5, you know, it's a great value. So our strategy automation is we've got a number coming online. We've already got 2 or 3, but this one meets PCG 2016/5, and again, lawyer's office, etc. So I'm going to jump out of here now, and I'm going to go into our program, which will effectively is unfortunately, just bear with me because this is mine. So I set up the program. So what we're looking here is shares or unit trusts, and I'll go through and I'll actually start a brand new one. I think I did one for myself, so I don't have to type for you because we're sort of running out of time. Let me go through LRBA shares. I'll see if I've got that one there. I think that's the one that I was working on. So I'll relaunch the interview. So this is the guts of our system, the Smith Family Super Fund. So this is the guts of our system. It's called Hot Docs, as you can see up the top there. Now, when you go into our LightYear Docs, you can see that it bears no resemblance to that. In fact, I might have, if I go here just to show you, I think I've got that, LightYear. As you can see here, this bears no resemblance. If I wanted to do a strategy automation, I wanted to do a related party. This is for a property, as you can see. If I went in and I bought the document, okay, I'd have to log in. But if you can see here, there's certainly, it's a completely different look and feel. But what we do is we use the LightYear Docs platform, the Hot Docs platform, and this is what you're dealing with. Now, the reason we do that is because it's scalable and really allows us to do up to 100,000 documents a day if we choose to see fit, which is why our pricing and our automation expenses are completely very low. So let's go through. So the first one is, remember we went through that PCG and we went through that document index. So the first one is minutes of the trustee of the fund. So we put in the Smith Family Super Fund. Generally, it's highly recommended to have corporate trustees. So we put in a company there. We've got the Smith trustee, ACN, and we've got one director there, which is John Smith. So he's a director. Obviously, if it was just individual trustees, we'd be in a dangerous position there that obviously you just can't have one one individual trustee. We use a corporate trustee. So from that one is we now go to setting up the Bear Trust or a holding trust. The Commissioner calls it a holding trust, but a lot of people call it a Bear Trust. What has to happen is the reason we've got these holding or Bear Trusts to hold the shares or property is effectively it limits the recourse by the lender as against the trustee. If it was held directly, if the loan was directly to the trustee of the super fund, then the trustee would be up for any loans in the event of default and would have to tap into other members of the fund to cover any lending. Whereas here before, as I said, if I set this up and the share price tanks by 70 or 80%, I might just simply walk away from the loan, take the loss inside the fund and hand the share back to John Smith, which is the lender. So we've got the Smith Share Trust, which is the holding trust. I've got an individual, so John can still be the sole trustee of that holding trust. So he's the trustee. The beneficiary, the absolute beneficiary, is obviously the superannuation fund, which is what we effectively have done here. So we've set up the superannuation fund. If we then go through the minutes of the trustee, the share trust, so we've got the first set of minutes is dealing with acquiring, setting up the holding trust. That's by the SMSF. The second one now is the holding trust, or the trustee to bear trust, which is John Smith. As you can see here, is also the chair, needs to say, okay, well, these are the assets that we're acquiring. Now, the related party lender, we've got a company here, but I'm going to change that to an individual. So we're going to do John Smith. And again, we've got all the relevant dates. So we've changed that. So here's the related party lender. Remember, the amount that we lent is, okay, so it looks as though, sorry, I've chosen the wrong one, sorry. I've actually chosen the real estate. So apologies here. I've gone through, well, at least you're going to get a good value here. I'll go through and I will have to, I'll see what Emmanuel's done. So sorry about that. I'll have to go through here. I'll do it again. So you're going to be stuck here, Smith Super Fund. We'll go individual, Smith trustee, blah, 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 blah. Straight line, I'll go 5 Smith Street. Most of you are probably laughing your heads off and going, God, look, he's just hopeless at typing. So 2000. So 1 director. You can put in obviously 2+ directors. You can have as many directors as you want. Remember, particularly if you go up to 6-member fund. I did a session yesterday, but with 6-member fund, you could obviously have 6 directors. Next stage is, as we said, it's the minutes of the trustee meeting. So we'll set this up for tomorrow. John, we select here, which actually I just use that pre-fill, so that'll go there. So we've got Smith Street. Next one is the holding trust. So the holding trust is okay, blah, blah, blah. Individual, we'll just change this to John Smith. So again, 5 Smith Street, Sydney, New South Wales, 2000. Okay, so he's the only trustee, as we said. If we wanted to add an extra trustee, we simply need to do that. The minutes of the holding trust, again, we're going to do that tomorrow. Bang, bang. So he attended the meeting, he's the chair, and then what we do is we use 5 Smith Street again. So we go through. So we're actually going through the related party loan, individual. So we go through John. So as you can see, even though I had to go through and do the whole thing quickly, see how quickly even a dud like me is going through the process. Soon we'll have integrations so that if this is sitting in your, for example, if the companies are sitting in your CAS 360, you'll be able to pull the data out of there. So again, it's taken me virtually seconds to do that. Okay, so what I need to do here is work out the number of shares. So remember, it's 50%, so it's 5,000 shares of Westpac shares. If I wanted to, if I've got a HIN number, I can identify it, and that's probably pretty useless. Oh, sorry, pretty useless would be pretty useful. Now, if you're doing, coming back in, if I'm splitting it and I'm doing my holding trust, so the establishment of the holding trust, I might have here holding trust number 1, I might have Westpac 3 Westpac shares number 1. Now remember, for the shares itself, I've got I could do 2.5, or I could do, remember, because if we have a look at it, 5,000 of the shares are actually going to be contributed in specie by way of concessional contribution and non-concessional. The other 5,000 is here. So I'll do the whole 5,000. The consideration for that, the deemed consideration is $120,000. The loan amount is, so in fact it's not, it's 10,000. Sorry about that, it's 10,000. Consideration is 240,000, and then the loan amount is $120,000. So because they all have to be parcelled. Because it's a shareholder loan, it's 7 years, 7.94%. Now, if you can go out to the market and get different terms and put those in, well, you can obviously change those, but we pre-fill them there for you. Fixed, New South Wales, you are going to have to work out what the interest payable per month was. We said it was around about $9,000 for 12 months. So we might simply go 2,000, sorry, this is probably not the best figures because I've got my calculator. And then we need to put a mortgage deed, etc. So we'll start up everything there. So that's it. When we go through and we've built our little instalment warrant. So it's chugging away. Again, this is the back of the scene. You'll find I get a Word document. So whereas you guys will actually get a PDF. But we are in a position now, if you have to go back and change, you can always go back and relaunch the interview at any point in time. So you'll see a relaunch button, and that essentially will enable you to go back and change the figures. Previously, we were doing it in 24 hours, but I think actually it's gone up to, effectively it's gone up to like a couple of weeks now if you need to go back, particularly around this, because obviously there's a lot of figures and you're working out exactly where you want to go. So you got a related LRBA establishment pack. You know, one of we went through this before. We've got the Commissioner's ruling here, which we've put in the guidelines. Again, one of the benefits of doing it now, for example, Westpac shares, is I'm getting the franking credits in the fund to reduce in part my contributions tax from the concessional contribution, knowing that it's payable in December. I went to start to do NABs, but with NAB, their payment was like the 4th of July with their franking credits. So I'd get another interim or middle year dividend payment, but for me, it wouldn't work. So Westpac shares were perfect. So just be careful on the way you do it and parcel up. So the first thing is the minutes of the trustee of the fund. Remember, we sort of went through this. So what we've got is the Smith Superannuation Fund, attended by, obviously I didn't click that button, sorry about that. John Smith was elected as chairperson. So when you get a little area like that, it means I didn't, excuse me, I didn't click the button. So you can go back and change that. So what we're doing is we're setting up a holding trust, and also you can see that setting up a holding trust and entering into a limited recourse buying arrangement of the Commissioner's PCG. So that's our first meeting, 10,000 Westpac shares, blah, 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 through that. And then it's a corporate trustee, so therefore John just signs there. The second one is the deed of holding trust. So Westpac shares number 1, remember that's if we wanted to split it up. I've done 10,000 here, but we could have just been for 3,000 if we wanted to do that. So we've got the trustee of the holding trust, that's John Smith, trustee of the superannuation fund, so on and so forth, who's the beneficiary. And then we go through all the, it's quite detailed documentation there. And then we're going to see that it's executed by both parties. We've got John Smith, who's the trustee of the holding trust, and he's witnessing where he's just individual, and also the trustee of the super fund. And here's our schedule, which deals with the holding trust property. As I said before, I'd probably do 2 or 3 of these. But you can see, I mean, even dunderhead like me ripped through this whole document in, 4 or 5 minutes. I had to go back and recalculate. So as long as you get your figures, you worked out your numbers, it's very easy to do. I could do 3 of these in 20 minutes. If I could do that, you could probably do it in 5. We then go through the minutes of the holding trust. So again, obviously, John's you can see I've done the button, whereas I didn't do it for the other one. So he's the trustee. We go through and they're acquiring a single acquirable asset. As you can see, a lot of the fields really flow through to the multi-documents. That's why it's easy to do the automation. You mentioned what a nightmare it would be trying to pull all these documents together. Now, the related party loan agreement between the trustee and John being the lender. We've got quite extensive terms and conditions that fit with 2016/5. Again, we've got a lot of schedules. You can see there at 7.9%, blah, 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 goes through, pay a loan amount. So I think we've also got here lenders to take charge over the borrower's property, which is required under PCG. And then we go through the process here. Again, these are all legally signed off by TGA Legal. And then we've got the signatures down the bottom. So it's between the lender and also the borrower, which is the Smith trustee. It's actually the trustee, the fund that borrows. It's not the holding trust. The holding trust just simply holds legal title. And so we've got the term of the loan agreement there. And then finally, we've got the mortgage deed, which is required under PCG. And that mortgage deed needs to be registered, which will probably under PPL it would do, because it's not, obviously it's not property. So we go through. The mortgagee is John Smith, and the mortgagor is obviously the trustee of the superannuation fund. But again, the mortgage is just limited to those shares, nothing else. So we don't do, if you want, well, you don't do personal guarantee here. If you wanted to, you can put in a personal guarantee, but generally we don't put that in place. So effectively, that's our LRBA. If we go back and just finish off on this one. So that's our instalment warrant. The key I would put to you is to work out whether it's going to really work well is to go through the case study, the same here. What shares do they have outside? What capital gains tax do they have outside? What are the franking credits outside? Do they have other income outside that can be sheltered? Remember that 15% tax offset that can be quite useful. Then more importantly, what capital gains tax can we get rid of? Are they over, or are you over the $1.6 million T-bar? So those shares actually have to fit in. Well, they don't have to fit in, but they generally go into the accumulation account. So there's a lot of those sort of issues to look at. If he's over 65, then you can do it up to age 75. Remember the 40 hours of work in 30-day period, but you can easily suffice that if you're self-employed and you're actually a share trader. But his NCC is limited to $100,000, which wasn't a big issue for us. So for us, it's going to be, well, how much are we actually going to claim as a, sorry, the next one, how much are we going to claim as a concessional contribution? Don't worry about the cap, because simply the excess concessional is to be added back to his assessable income. So it's a good strategy. Have a look at it time and again. It's now going to be available on the site. I'll release it next Tuesday. I'll send out a release detail to all of you who are on the webinar. And more importantly, I'll probably do this case study up just in some basic figures so you can have a look at how I've worked it out. And more importantly, I know you're probably going to pull it to pieces and say, well, hold on, you forgot this offset or forgot that, or forgot the Medicare levy, etc. But look, I've got a couple of questions. So Paul Tynan, great to see you, Paul. Can the collection be a bunch of listed shares held in a single unit trust? So you can't transfer, well, you can't transfer the units in the unit trust in because it's not listed. Remember the PCG 2016/5 says it only applies to listed shares. But if the listed shares are in the unit trust, then likewise we can transfer them into the self-managed super fund from the trustee of the unit trust into the SMSF. Now the capital gains tax, what I would do there is, again, to get a deduction, what we would do is we get the trustee of the unit trust to employ an individual. So it's transferred as a wage, which would then give the deduction inside the unit trust. Really good question from Liam. And it's a brilliant question, Liam, again, and I'd expect it of you. Generally, one of my big things is to use bucket companies for related party loans. Now here what I've done is I've actually just transferred shares in as a related party loan, but other striations and variations of this is, for example, if I've got a bucket company and effectively I've got a lot of cash in there, I could go out and buy a parcel of shares inside my self-managed super fund and go to a 50% LVR by half of it being funded by a bucket company, if that makes sense. So here I've done it one way where the shares are owned by John Smith, he's transferred them in. But if we've got cash elsewhere, we can still use a related party loan to go and get new shares on the market, if that makes sense, or even buy them off John Smith if he needs the cash. So what we do there, though, is Division 7A requires if there's a mortgage, generally, if there's a mortgage, it's a 25-year term you can do, otherwise it's 7. So you're still stuck with a 7-year. The difference is going to be in terms of the interest rates under Division 7A, which is slightly higher, I think. I'm only just doing my Div 7A document at the moment. So there is a conflict between the safe harbour and, more importantly, Div 7A. So I probably, I'm not sure what I'd do. If you leave it with me, Liam, I'll go back, and this is something I've tossed around for a number of years. Let me go back and when I come back on Tuesday with the relevant case study, etc., and notify you that this is up and running, I'll put this in the Q&A section for that actual document, so you can have a look at it, and I'll see if I can get clarification from the tax office. But again, brilliant question, and don't worry, I've tossed it around for years. But as you can see, from our perspective, it's a great strategy. I looked at one element of it, but get it around in your head, and more importantly, I learn as much as I can from all of you guys. So please feel free to throw cases studies at me and just say, look, Grant, I've got this. Can I do that? What about if I did this, or what if I could do that? For example, Paul, if you have a look at the unit on the unit trust. Although PCG 2016/5 doesn't apply, embedded in that regulation and also the rules is that if you can find someone else who would lend on those units in that unit trust, and it might be peer-to-peer lending, then effectively you can copy those terms, which is why when we have a look, we've got an indicative rate, but if you can find someone else, you have to mirror their terms. So if they'll lend to you, absolutely, you can transfer those units in. Anyway, we've got quite a lot I've done. This is my second webinar for the week. I'm doing about 2 or 3, which is important for us to get our CPD up. Anyway, that's probably enough for me. Contact us at support@ilovesmsf.com or support@lightyeardocs.com.au. We've got quite a long list of more strategy automation coming through. The next one that I want to do is wind-ups of an SMSF, which obviously is quite a lot of documents together. Div 7A is coming out very shortly, as are a number of our loan agreements. Our loan agreements are strategy automation because with a loan agreement, you can add a mortgage deed and a personal guarantee, or choose neither of them. Anyway, it's Grant Abbott. If you've got any questions, or you'd like to jump onto the LightYear Docs site, start to use it, or like to have a discussion with us around that, please, here we go. Please feel free to contact us ASAP. It's Grant Abbott signing off.